There you're watching the Mutual Fund Corner. This is a show where we answer all your mutual fund related queries. And before we do that, the markets, they're yo-yoing a tad bit. We have the Nifty and the Sensex, which have recovered a fair amount from the lows. And that is courtesy the Nifty Bank, which is sitting with a gain of almost 0.75%. And that's led higher by a couple of these private sector banks. We have the likes of HDFC Bank, which has seen a bit of recovery. And ICICI Bank, that's the one which is actually at the high point of trade. Alongside that, we have the mid-cap index as well. In the morning, it was underperforming the frontline indices, and now it's bounced right back, just about to break into the green. And the advanced decline ratio as well, it's narrowed a tad bit. Yes, it's still favoring the declines, but it is narrowed to just around 2 stocks which are in the red for 1 in the green. So with that out of the way, let's invite both our guests on the show. We have Tarun Birani, the founder and CEO of TBNG Capital Advisors, as well as Harshvardhan Roongta of Roongta Securities, joining in to answer all your mutual fund related queries. Good afternoon and thanks a lot, gentlemen. Hope you're keeping home and you are safe as well. With that, we have the first query of the day. This one comes in from Major General Brajesh, who writes to us on Twitter. He wants to know if a short-term debt fund direct growth, a good investment bet for senior citizens. So basically, a short-term debt fund with direct growth, is that a good option for senior citizens? He is a Major General, he is a senior citizen, has a lock-in period of around 3 to 5 years, and also wants to know a little about alternative debt funds. So Harshvardhan, let me come right across to you with this query. For a senior citizen, what do you think is the best way to go?
So yes, in fact, I personally have been suggesting that the short-term debt fund category is in fact the best suited for any layman investor. If we're looking at a retail investor who does not really understand the movements of interest rates and the impact on the debt portfolios, I think short-term debt funds are best suited because they are best suited to take the advantage of the interest rate movements. In case the interest rates are coming down, they'll capture the returns better. And in case they're going up, it has lower volatility when compared to, say, medium or long-term bonds. Now, if you look at the short-term debt funds, the SEBI definition is very clear. It says that the average maturity, the macular duration of short-term funds should be anywhere between 1 and 3 years. So, as I said, this just gets in the best, the sweet spot wherein you will have the advantages of a interest rate movement being captured with lower volatility. Now, if I were to explain this, this concept as to what am I trying to say when I say it captures the interest rate movement a little better, lowers the volatility, we can use this one particular example. Now, this is just an example for illustration purposes. I picked up 3 schemes of ICICI, and the reason I picked up ICICI is only because they had one product in the short term, in the medium term, and the long term. So if I were to just explain this, so if I just look at this particular fund, which is ICICI short-term fund. Now, as I said, SEBI has defined the average maturity of short-term funds to be in the range of 1 to 3 years. Now, if you look at the month of February, if I look at just the returns of the month of February itself, why have I picked February? Because we saw after the announcement of the budget, the interest rates started going up because the finance minister announced the borrowing program of the government, which was to the extent of 12 lakh crores in this particular financial year. So interest rates started shooting up. So if you see the 1 month return of a short-term fund was a negative 22 basis points. So it was minus 2%. Now the same thing if I look at it in a medium-term fund, which as per definition is between a macular duration of 3 to 4 years, the negative return in that particular month was 0.23%. So a negative of 23 basis points. Now the same thing if I were to see in a long-term fund, which has an average maturity as per SEBI definition of more than 7 years. So naturally the impact is going to be much higher. So you found the investors in a long-term fund experienced a negative return of 3 percentage points. So you see the volatility. The longer the duration, the volatility is going to be higher. Now, if you're shorter end of the tenure, then the volatility is comparatively less. Now, if I were to just look at the last 1 year return, okay, so volatility is less, but what did I get at the end of it? So if I just take one last 1 year return of these 3 funds, the short-term fund has given a return, an annualized return of 10.83%. A medium term has given 11% and a long term has given 8.75. Now these data points that I've given is a bit fragmented. You can't just really compare it point to point because lots of things have happened. The interest rates have started coming down again. So the returns of the last 1 year are looking better. So as I said, this is only for illustration purposes and not actually what we're trying to communicate. What I'm only trying to make an investor understand is that the short-term fund is best placed for a retail investor to get returns which possibly could be in excess of a bank fixed deposit. And because it's a debt fund, and if you hold it for more than 3 years, which clearly is the time horizon for this viewer, Major General Brajesh, is between 3 to 5 years. So I think short-term funds is best suited to capture the preferred tax benefits, which is long-term capital gains will be taxed at a preferred rate of 20% with indexation when compared to fixed deposits, and the possibility of getting slightly higher returns are definitely there. If you look at anything less than 1 year, the chances of beating and getting a return higher than fixed deposits will be very less. So I think short-term debt funds is the best category for retail investors.
All right, we take that point. Thanks a lot for explaining that to us exhaustively, Harsh. The next query is up for Tarun Tushar. Why writes to us via an email. He wants to know if the floating rate funds, if they are a good choice for investment of 2 years. Tarun, this is an interesting question, primarily because of the way the interest rates are poised right now. When the interest rates are low, you want to perhaps, get the benefit of a higher rate perhaps sometime later. And when they are higher, you want to lock them in. So in that situation, floating rate investments for the next 2 years, how do you see them?
Great. So very good question. I think floating rate, we all know, has been primarily used to take loans. As we take home loans are primarily moving into floating rate category. So as the interest rates keep changing, you keep getting the benefit. And in India, we have seen the floating rate products in the loan segment has done very well. Now, coming to the floating rate concept in investing. So what is a floating rate fund? These are normally in India is created through a combination of fixed income bond and a synthetic instrument such as a swap, where they try to hedge the risk against the risk of the interest rate, changes in the interest rate. So there is a bit of complexity in that, understanding the product in the right context, as the return can be function of the fixed income instrument as well as the capital gain loss arising due to the swap spread that the interest investor will earn and lose. Okay, so no doubt they have performed very well in last 2 years, because we have seen a trend where the interest rates have been going down. But looking at the environment where we are in right now and the government borrowing program, where RBI is supporting the liquidity as we speak today, but going forward, as we fast forward next 4 to 6 quarter and the normalcy resumes in the economy, we see that RBI targeting the increased inflation as we see presently does look that interest rates can be volatile. So again, to understand the performance, it requires analyzing the impact of these swaps. And to my mind, there could be a good chance of a capital loss arising due to if there is a rise in the interest rate. So in this current environment, as we speak, I feel for a 2-year kind of horizon, a AAA rated security, many short duration fund, banking and PSU funds, and some corporate bond funds are best positioned to benefit from them rather than a floating rate fund. Thank you.
All right, thanks a lot for that. In fact, gentlemen, I'll have to ask you to keep your answers a little crisp so that we can answer a lot more queries coming in from the viewers. The next one for Harshvardhan. Krishnalal writes to us from Meerut. He's worried about investing in debt funds, except liquid funds, especially after the Franklin episode. Are there any safe funds for investors to go ahead and park their money, is his question. And Harshvardhan, it's a valid question after what took place in the Franklin episode. So what would you suggest to him?
So as you said, it's very natural for an investor to get, completely spooked about what is happening in the debt space after looking at what Franklin episode happened. So if you understand, SEBI has essentially categorized, in the debt segment, it has got 16 types of schemes wherein an investor can park their money. And each type, has got a very specific guidelines which the fund houses are supposed to, follow in spirit and word. What Franklin did essentially was, at the face of things, everything looked fine as if they're compliant with the regulation, but in the spirit they were missing there. So they just conveniently found some loopholes in those guidelines, and that actually led to illiquidity and all those episodes. So what we need to keep in mind, the regulations are very clear, defining all the 16 schemes based on 2 parameters. One is the duration of which the papers that will be invested in that particular fund, and the credit quality. So I think what this investor can do is very clearly look at a good match which matches the duration of his time horizon as well, and look at schemes which invest in high quality papers which are rated and those kind of papers. So he gets a match of both, where he can match the duration with the tenure of his investment and also get a good quality paper. So I just mentioned about the short term funds. I think that is something that he can look at.
Alright gentlemen, the breaking news this afternoon is that all the frontline indices have now moved into the green, the Sensex, the Nifty as well as the mid-cap index, and that's primarily because of the big surge that we're seeing in the Nifty Bank. The Nifty Bank, when we started the show about a few minutes ago, was up by 0.75%, and now that gain has accelerated to over 1%, and that's led to the Nifty just about breaking into the green. We have HDFC Bank, which continues to surge. We have ICICI Bank, which does well as well. Important to track as we move on into the last hour of trade, and that's primarily because it's also the weekly options expiry. What we'll do is take a short break, come back, answer more of your mutual fund related queries. Welcome back. Doing well for the markets, but it is raining a lot of mutual fund queries. So let's get on with the conversation that we're having with both Harsh as well as Tarun. And we have a query coming in. Ganesh writes to us. Ganesh writes to us from Gurgaon. He has a lot of investments in the mutual fund, multiple funds in his portfolio, wants us to assess what he's doing. Well, he is retired, and a lot of these mutual funds that he's invested in are from July 2019, which is pre-COVID levels. And some of them he's listed out. This Mirai Asset Large Cap, he's got Kotak Flexi Cap Fund, he's got investments in ICICI Pru Balance Advantage Funds, also has Nippon Large Cap, L&T Infrastructure Fund, and Kotak Global Emerging Fund. So Tarun, he has a fair amount of investments, but no significant chunk in mid or small caps. There is one Flexi Cap, there is Balance Advantage, but there is a thematic fund, and a lot of them are large cap and some global emerging as well. So is that something that you would recommend to a person who's retired and has 30% of his investments in MFN stock?
Sure. So I would like to address this question in two parts. First is the suitability part. Since Ganesh mentioned that clearly that he's retired and almost 30% of his portfolio is outside, 30% is into equity-oriented investments, or mutual funds. So I am assuming that 70% of the money is lying into fixed income, fixed deposit, PPF, and all those other kind of instruments. So once that part is clear, from a suitability point of view, from a risk assessment point of view, Mr. Ganesh need to be very clear that how much risk he is willing to take. So on this 30% of the money, if this goes up, down, let's say, coming to the last year example, 30% down, is he ready for a paper drawdown kind of loss on a portfolio? That is a very important suitability assessment you need to do for yourself. If he is very clear on that part, I think his portfolio is very well poised in terms of selection of funds in the portfolio. He has a good large cap fund, which has a good 10-year track record. He has a good flexi cap. The balance advantage strategy, again, is suitable looking at his retired profile. Again, just because he is retired, it doesn't mean he need to be into fixed income only. Because the interest rates currently are not conducive enough to earn significant returns or beat the inflation. I strongly feel a 30% portfolio into mutual fund or equity makes a lot of sense. Maybe one of his fund, Reliance Large Cap, he want to review it after some quarters. I may want to consolidate into Mirai Large Cap from Nippon. Sorry. Again, infrastructure in this portfolio, I feel is a dragger. These infrastructure funds have been mostly wealth destructors, and we have observed over the last 10-year period, they have not been able to give alpha creation. Instead of that, my suggestion would be to switch this to either one of the mid-cap funds, because that will help him get much more diversified portfolio and get better alpha in his portfolio. He has a good mix of emerging market fund, global fund in the portfolio. But my suggestion is, looking at the global GDP construct, he should be more biased towards North America compared to an emerging market, looking at his retired profile. Yes, thank you so much.
All right, Tarun, while you were speaking, there were flashes at the bottom of the screen, which were basically clarifications on the Delhi government restrictions, cinema to operate with 30% on weekdays, to remain shut on the weekends, malls, gyms, spas, all of them will be shut on the weekdays as well as weekends. And all of these, clarifications that are coming in are effective tomorrow. So we'll keep an eye out on that. Of course, from a cinema standpoint, doesn't make a big difference because there aren't a lot of movies which are releasing already for people to go ahead and visit those cinema halls. But let's talk about some more queries from Surat. We have Riddhi Shah writing to us, wants to know advice on multi-cap funds and if they should be included in the portfolio. Harsh, quickly your thoughts?
Yes, actually, I'm a big, advocate of a multi-cap fund, especially after the new guidelines of SEBI, which mandate all the multi-cap to have an equal proportion of 25% at least in a large, mid, and small cap, and the balance can be invested as per the fund manager's decision. So, this enables an investor to have an allocation across all market segments. So, I think this is one of the good options for an investor who wants to split the money across different market segments. Now, unfortunately, because of these new guidelines, there are only a few funds in this category as of now. But very soon, you will find that all the AMCs will introduce one of a multi-cap fund so that they can complete the basket of offerings for investors. At this moment, you have the three top performing funds in this category would be the Nippon Multi-Cap, the ICICI Multi-Cap, and Invesco Multi-Cap. So I think Riddhi could possibly pick up any of the investments, any of these three schemes that she likes.
All right, we take that point. The next query comes in from Lucknow. Rajat Bhardwaj writes to us. Rajat unfortunately lost his job in 2020 due to downsizing from the pandemic and was on track to fulfilling a target of 80 lakh rupees in the next 20 years with an investment of up to 11,000 in different schemes since 2015. His investments have stopped since April 2020. He wants to ask how to resume investing in such a way that his money lost be recovered and invest in his investments again. Is there a way out? It's an interesting question, Tarun, because I'm sure a lot of people unfortunately lost their jobs during the pandemic. A lot may, as we are looking at the second wave of this pandemic as well. How do they manage and navigate through their long-term financial goals despite these hiccups in their career? Maybe via Rajat, you can answer to a lot of the people who might be facing similar situations.
Sure. So, first of all, my quick assessment is the investing success is not achieved by investing into right asset. It is all about investing or avoiding the wrong ones. That is where one can look at. Currently, as Rajat mentioned, that since he has not been able to invest for some time because of the job loss, it doesn't mean that he should look at risky ventures. Because I have seen many times people look at risky ventures to make up for the loss what they had due to this time period. They should avoid doing that. And my strong suggestion would be that once he resumes his work or once he start getting income as well as savings, he should start looking at in a much more structured way rather than trying to make up the lost time by investing into something which is risky. Because it really doesn't make sense, because I understand at this situation many people doesn't have a right mix of income stream available, so it is quite possible they need to chip in into savings also in future. So it just doesn't make sense to move any asset to the risky investment, and stay liquid as much as possible. Keep 5 to 6 months of contingency balance available so that in case of you don't get a job in next 5-6 months, you have a good contingency fund to take care of. Thank you.
All right, we take that point, and with that we move on to the last query of the day. Brajraj writes to us on Twitter. He's a new investor, wants to know if the AUM growth is different or is dependent only on fund managers' approach and investment, or it is the Nifty performance. Well, it's a novice query, and I'm sure a lot of people would want to know this. Harsh, your thoughts?
See, the AUM of a particular scheme goes up under two circumstances. The fresh money that comes into the scheme, like it's an open-ended fund, investors are putting in fresh amount of money in the scheme. So AUM will go up. And on the other circumstances, all the existing investments that have been made in that particular scheme, the value of that continuously keep going up. So the AUM, the overall AUM of that scheme will look bigger and it'll keep going up. Now, assume a situation wherein a fund house has stopped accepting fresh investment. So there is a possibility a fund house may say that we don't want any fresh money in this particular scheme, which happens usually in the small cap category. So what happens is now the fresh AUM has stopped coming, but still you will see the AUM is going up. Now that could happen because the market is going up and the value of underlying assets are going up. Now another scenario. Now, in one situation, you will feel that the market is going up, but the AUM of the scheme is coming down. Now, that could happen because of a situation wherein there are more redemptions. So, the fund houses stop accepting fresh investments, the market is going up, but redemptions are being allowed. So the AUM is actually a factor of how much money is coming in or going out, and what the value of underlying assets are doing. So performance, if I understand his question correctly, says what is the dependency on fund managers' approach and investment or on Nifty performance. So I think it's more to do with the cash flows coming and going out and the performance of the underlying assets. Could be debt or could be equity for that matter.
All right, important clarification there. In fact, on that note, we'll thank both Tarun and Harsh for taking the time out, helping all our viewers with their mutual fund related queries. For all your queries, keep writing to us on CNBC TV18 Twitter handle, or email them to us every Tuesdays and Thursdays. We will take them up with our mutual fund experts. With that, we're out of time on this show, but we hand it over to the team of Closing Bell for an interesting last hour of trade. It's weekly options expiry. The market's recovering from the lows, holding on to those recoveries. You don't want to miss this last hour.